Following the bankruptcy of cryptocurrency exchange FTX, many people are worried about contagion into other cryptocurrency exchanges, other cryptocurrencies, but also into the real economy. So in this video, we look through what happened and the reasons behind it, but also look at those possible contagion routes and also some potential solutions, because I think there could be some good that actually comes out of this. Now, if you do enjoy our content, don't forget to subscribe to our channel. It's free to do so and you won't miss any new videos. So let's look at the contagion following the FTX bankruptcy in a bit more detail. Let's begin with the cast of characters in this tragedy. Now, it's as if this whole sequence of events was designed for a Netflix movie. In fact, some people have already come up with some suggestions for who the actors should be, but the key character is Sam Bankman-Fried, whose initials are SBF. He's the CEO of the exchange, FTX. There's a kind of related company, which is Alameda Research, which despite its name was essentially a proprietary trading company, almost like an embedded hedge fund. And the CEO of Alameda is Caroline Ellison. Then a separate but also very important entity in the story is Binance, which is the largest cryptocurrency exchange. And the CEO of Binance is called Changpeng Zhao, or CZ. That's his abbreviation. So the two central characters are SBF and CZ. And if we look at the size of cryptocurrency exchanges, this is just before the default of FTX, you can see that FTX comes out at number 5 by volume. The largest by far was Binance. However, when an exchange this large goes down, it'll have ripple effects throughout the entire cryptocurrency market, and potentially beyond, as we'll see. Now, before November, when everything kicked off, Sam Bankman-Fried, or SBF, was lauded as a kind of savior in the cryptocurrency space because he actually bailed out a lot of the platforms which started going down. So for example, BlockFi, which I actually made a video about where you can do yield farming, which is centralized on an exchange, that ran into problems. And Sam Bankman-Fried actually provided capital to allow them to continue their business. Voyager Digital was another platform that ran into trouble, and again, SBF bailed them out, or at least he bought their assets after they hit the skids. And this has led some, including Jim Cramer, to say that he's a little bit like JP Morgan, who bailed out a lot of banks during the Great Depression. To be fair, that was for his own gain, and he actually increased his foothold in the banking space as a result. And it looked like SBF was doing the same thing. Now, what should a regulated exchange do? On the face of it, it's really simple. If you've got a customer that wants to buy some Bitcoin, say, they provide money to the exchange buys it, and then safely stores the asset until they decide to sell it. So at any time, the customer should be able to go back to the platform and say, look, I want to sell my Bitcoin, give me my money back. It should never be the case that the customer can't do that. And all customers should be able to do that simultaneously. This isn't like a bank where they don't actually have your money. For an exchange, there are no excuses. And that's because a regulated exchange has to follow this rule in the United States. It's called 15c33, but the gist is that customer cash and securities are segregated from those of the broker itself. And the key consequence of that is that the broker can't use the client's stuff. So for example, if it wants to trade on its own account, it can't use the customer's money to do that. And what it looks like happened with FTX is that it was doing that. It was taking client money and investing it. Some of it was given to Alameda Research in order to essentially run the money like a hedge fund. Now, while the profits are good and crypto's going up, that wasn't a problem. But when markets went into reverse, the losses mounted up, and eventually this has come to light. And that's because FTX doesn't have the equivalent of this custody rule which applies to its customers. And even SBF seems confused about the nature of his business. So here he's saying he's got too much leverage, more than he realized, but he says that there's a run on the bank and that market crash exhausted liquidity. Well, that should never happen because the client's assets should be looked after. They should be in a custodial account and the money should always be there for them to get their stuff back. And it's probably been the worst week for cryptocurrency ever. Things really started with this article from CoinDesk which was pointing out some details about the balance sheet for Alameda Research. And its point was that the two, FTX, the exchange, and Alameda Research, which is the kind of hedge fund for crypto, were closely tied. Now that's worrying because an exchange should be very, very safe. And if it's tied to the fate of a hedge fund and the hedge fund goes down, that questions the stability of the platform. Now the linkage between the two was via this asset. And that was a token created by FTX, which is called FTX token or FTT. That's the ticker. Now, potentially as a consequence of that report, perhaps not, perhaps there was extra information provided, CZ, who's the CEO of Binance, the big competitor to FTX, who'd sold his stake in the company some while back, but taken FTT as partial payment for that sale, suddenly announced on November the 6th that he was about to sell all of his remaining holdings of FTT. And it was a very large amount. It was $2.1 billion worth of the token. Now, he says that he tried to do this in a way that minimizes market impact. Whether that's possible or not, I question. If you're dumping a huge amount of a token onto the market, it's going to reduce the price. And that in turn calls into question this relationship between FTX and Alameda Research. If Alameda Research holds a lot of the token, that's going to reduce its assets a lot. And based on the report that we saw, that might also destabilize FTX. Now, naturally, SBF tweeted about this and he denied it. He said there are lots of unfounded rumors about the balance sheet of Alameda Research. And here's Caroline Capital, the CEO of Alameda Research, whose tweet he's actually quoting here. But he says that FTX keeps audited financials. And even though it slows down FTX, they're highly regulated. And in a tweet which has since been deleted, he said a competitor, presumably Binance, is trying to go after us with false rumors. FTX is fine. Assets are fine. Now that's always a red flag when the CEO says something like that. Now things must have got pretty bad because despite the animosity between SBF and CZ, they came to an agreement whereby there'd be an offer to buy FTX by Binance. So if you were cynical, it looks a little bit like CZ was doing a JP Morgan here, destabilizing one of his competitors and buying it back at a bargain price. Now, of course, he denies that, but it does look a little bit suspicious. Then on November the 9th, US regulators announced they were investigating whether FTX properly handled client funds and also its lending business. And that was really the death knell for FTX because Binance backed out of the deal. It wasn't going to rescue FTX, and consequently, almost inevitably, FTX announced that it was filing for bankruptcy in the US. Now, the value of the FTX token crashed pretty much on November the 8th, and it hasn't really recovered. It was trading at more than $25. It's now trading at less than $2. And of course, FTX is now bankrupt. Now, this week I've done something a little bit different for me, which is to record a show for a third party, which is called Curio. And this is an app that lets you listen to journalism, but do it in audio format. Now, if you are trying to build up your wealth for your retirement, and cryptocurrency was seen as a bit of a shortcut until recently, now that we've seen this big fall in the value of cryptocurrency assets, many people feel that there's a big setback and it's going to take much longer to get there to retirement. And if they were planning to retire early due to huge cryptocurrency returns, that's looking even less likely. So the purpose of the show is to show you exactly what is required in order to reach a reasonable retirement goal. And it's surprising how much you have to save. So that's what I focused on during the show. And I do talk about cryptocurrency as well. Here's the Curio platform, so you see what it looks like. Of course, it works on your mobile phone as well. And you can see it has journalism from a wide variety of sources, including the FT, which I found very useful, but also the Wall Street Journal and The Economist. So let's look for my episode, and here it is, Ramin Fire. And this is going to be a whole series where they get experts to talk about personal finance. But I can't help but notice that my episode is not trending. So let's see if we can fix that. If you go onto Curio, let's see if we can get it slightly further up the list. I'd appreciate it. Now you can see there's a 7-day free trial, so you don't have to pay up front in order to listen to the episode. And the annual subscription itself is only £5 a month, which is a lot less than subscribing to a lot of these journals. So if you do want to explore that, there's a link in the description below, which will allow you to go straight to the curio.io website. Now let's look at the state of FTX's balance sheet just before the bankruptcy. It's not a proper balance sheet. It does list assets and liabilities. So the assets are split into 3 groups: liquid assets, less liquid, and illiquid. And then the liabilities are here. It also shows the size of the redemptions, the withdrawals from the platform on Sunday just before the collapse. And those were huge. It was $5 billion. And that was just over one weekend. But there are some really worrying things. For example, one entry here for minus $8 billion is labeled hidden, poorly internally labeled fiat account. I've got no idea what that even means. But importantly, it's a big loss. And if we look at the assets, there's a lot of wrong way risk here. In other words, the balance sheet is kind of shored up with tokens which this company has itself created, such as FTX token, but also Serum. In fact, that's the largest less liquid holding in this middle column. And as you can see, Serum is a high-speed, non-custodial, decentralized derivatives exchange which sits on a blockchain, which is kind of cool. The idea being that it would enable the best of both centralized and decentralized world. An exchange which is censorship resistant, non-custodial, which is fast, inexpensive, and highly liquid. But from the point of view of someone looking at the balance sheet, what's really worrying is that it's created by FTX and Alameda Research. So this is something they've created themselves out of nothing, and it's being used to shore up their own balance sheet. The reason why it's wrong way risk is that if faith in FTX or Alameda Research starts to fall, so will the value of the token, so will the value of the assets, because it holds a lot of Serum and FTT, and then it goes into a kind of death spiral. What you don't want is an asset which is itself tied to the fate of the company and the credit quality of the company. But that's exactly what we see in large amounts on this balance sheet. And if we add up the numbers, the liabilities are the things which are owed to the customers. And these are all very liquid and quite easily priced assets, such as euros, dollars, Bitcoin, Ethereum, Tether. But if we look at the asset side of the balance sheet, it has a lot of this illiquid stuff. And if we add up the value of the liquid, less liquid, and illiquid assets, it comes to just under $10 billion. So on the face of it, it looks like the assets exceed the liabilities and everything's okay. But because the withdrawals were $5 billion on a single day, essentially, all that FTX could do was have time to sell its most liquid assets. And it only had less than $1 billion of those. So it simply couldn't sell assets quickly enough to meet the redemptions. And of course, there's that worrying entry, which is the hidden, poorly internal labeled fiat account. Now, the distinction here between liquidity and solvency is very important because on the face of it, it looks like FTX was solvent. The value of its assets was comparable with its liabilities. So given long enough, it could have sold the assets eventually and paid out its creditors. But the problem it faced was a liquidity problem. It didn't have enough liquid assets to make those customers whole. And that's essentially what put an end to the company. And Matt Levine of Bloomberg put it beautifully when talking about that hidden, poorly internally labeled account entry. He said the result of adding or subtracting those numbers with ordinary numbers is not a number, it's prison. So the balance sheet of an exchange should never look like that. If there'd been proper custody of customer accounts and customer assets, this could never have happened. And I think people are justifiably angry that their assets are essentially lost. Now let's move on to the contagion following the bankruptcy. If you're wondering how many people were affected by the bankruptcy, these are the direct customers of FTX. This document is an addition to the bankruptcy filing where it says that in fact there could be more than 1 million creditors in these Chapter 11 cases. And then it talks about being able to email all of those customers to tell them how to go about trying to get their assets back. In fact, there are so many creditors that what they're going to have to do is file a consolidated list of the top 50 creditors. And they're aiming to do that by November the 18th. So that'll be interesting reading when it's published. Now, many entities were directly affected by the bankruptcy because they held assets on the exchange. For example, Genesis Trading, its derivatives arm, had $175 million of assets locked up in their FTX account when it went bankrupt. So hopefully they'll be able to claim some of that money back. If they can't, they're just going to have to take a hit. And a hedge fund called Ikigai has also had its assets essentially locked up on the platform. So here's Travis Kling, who's the founder and chief investment officer of the hedge fund. And you can almost hear the desperation in his voice when he's talking about what happened here in this tweet. He says, by the time we went to withdraw Monday morning, we got very little out. We're now stuck alongside everyone else. So even big institutional investors have been burnt by this bankruptcy. And then as I make this video, in fact, the repercussions are still happening. I've just heard that crypto broker Genesis Trading has halted redemptions at its loan unit. And they cite the unprecedented market turmoil created by FTX. And that's created abnormal withdrawal requests which have exceeded our current liquidity. Now that's worrying because when people are worried about one platform, they'll be worried about another. So people will be thinking, what's the next shoe to drop? Which is the next platform which is going to potentially become bankrupt? And presumably that's why they're withdrawing funds from Genesis's loan unit. And even if a company does have sufficient liquidity and it's fully solvent, it still might be impacted by these very rapid redemptions. And as we mentioned, BlockFi, which is a platform I've used in the past and which was bailed out by FTX, has had to pause platform activities. And as a consequence, people haven't been able to remove their money from the platform. So withdrawals from BlockFi continue to be paused. And they're also asking people not to put any new money onto the platform. Now, SBF was an incredible speaker. He was really good at convincing VCs to fund his company. So in a series of funding rounds, he got a huge amount of capital into the company, over $30 billion, with a wide range of venture capital companies, but also celebrities like Tom Brady and, of course, SoftBank or SB Investment Advisors, as it's described here. And even huge venture capital companies like Sequoia were keen to hand over their money. Sequoia's strapline is that it helps the daring build legendary companies. And as the FT says in an article about this, Sequoia was a prominent cheerleader for bankman-fried. In September, it published a lengthy hagiography of the FTX boss, saying his intellect is as awesome as it is intimidating. But after the bankruptcy, Sequoia wrote its $210 million investments down to zero and deleted that very glowing article. FTX also had lots of sponsorships. For example, Miami Heat, their stadium was called the FTX Arena. And it was actually a 19-year deal, I believe. Clearly that's been cut short. So certainly within the crypto space, there have been a lot of repercussions, and those are ongoing. If we look more widely at asset classes like the Nasdaq and the S&P 500, in fact, they're absolutely fine. There was a very low inflation print at the same day that all of the unpleasantness happened. And in fact, equity markets surged upwards around the world, and they've held on to those gains. So certainly for now, there doesn't seem to be a spillage into equity markets, for example. Within cryptocurrencies, however, you can see they all took a hit as a result of the bankruptcy. Ethereum, for example, is down 21% since the beginning of November, and these other cryptocurrencies, such as Bitcoin, are down by comparable amounts. But I think for contagion channels to the real economy, the one that worries me most is Tether and other stablecoins. Now, there was a bit of a wobble in Tether when all these events were unfolding, but notice the y-axis here is zoomed in very closely. So the value of Tether, of course, is always supposed to be $1. It almost fell by 1 cent, but not quite, and it recovered very quickly. What's the contagion route to the real economy? Well, the thing is that money market funds, which are absolutely huge, they have just under $5 trillion in assets in the United States, they buy the same assets as stablecoins. You can think of it like two pigs feeding from the same trough. So if money's pouring out of stablecoins, then they'd be forced sellers of these assets. Those would be things like commercial paper, very short-dated corporate bonds, also short-dated US treasuries like T-bill or certificates of deposit or reverse repo. Now, if the value of these assets fall very sharply because of stablecoin selling, it's going to affect the value of money market funds. And the one thing that a money market fund can't do is break the buck. If its value does fall below $1, there'll be big redemptions from those as well. And so I think we could enter this downward spiral triggered by redemptions from stablecoins. At least for now, that's not happening, but I think it's a key risk to watch. I said at the beginning it's not all negative, and I think there are some solutions. None of them are easy, and it's kind of amusing that this tweet from CZ suggests that they create something like a central bank, but for the crypto space. An industry recovery fund to help projects which are strong. In other words, they're solvent, but they have a liquidity problem. But I think the fundamental problem for the average investor is they don't know whether they can trust an exchange. I think it's not unreasonable to expect that if you buy something on an exchange, it should keep it safe and be willing to give you back the money for selling it at any point in time. The problem's not with the cryptocurrencies themselves. Those have continued to function through the crisis. It's the intermediaries which are the problem. The unregulated intermediaries. It's kind of like having to crawl through a sewage pipe to get to the good stuff. So how could we get rid of the sewage in the sewage pipe where we could have regulation, like that SEC rule about separation of assets and money? Or we could have a spot Bitcoin ETF. The US still doesn't have one of these. What's a spot ETF? It's one that doesn't buy futures in Bitcoin, so there are no derivatives involved. If you put money into the fund, it goes off and buys a bit more Bitcoin. Why would this be good? Well, for starters, you wouldn't need to go via one of these crypto exchanges. You trade the ETF on a regular, regulated exchange. And that comes with lots of goodies, apart from regulation. Firstly, the trading fees would be very low, just as they are for any other ETF. And if there's competition in the space, as there often is, then the management fees would also be very low. So in a single move, you could sidestep a lot of the problems with getting exposure to cryptocurrencies. But regulators simply don't like the idea of having these crypto ETFs. So it looks as if the forest fire of contagion within the crypto space is going to be carrying on for some time. And I suspect there'll be more casualties yet to come. But as far as contagion to the broader economy, that simply hasn't happened yet. And I think the most likely conduit, which is stablecoins, certainly have held up their value. They did have a little bit of a wobble, but it's nothing significant, and they have recovered. So don't forget our offer from Curio. If you do want to check it out, please do. It's a new platform for me, so I'm really excited for you to discover it. Just go to the link which is in the description below. I'd appreciate it. And, as always, thank you for listening.